And now we're going to jump into secret number 3 for the ultimate triad. And as you'll notice, the first one is, again, capital management. The second, asset management. The third is tax and cash flow management. So this is the third secret that we're going to capitalize and optimize, called the PRP Accelerator. Usually it's our consistent partners, Cunningham, Reed Scott, Verdon, all the guys that have sent us lots of business over the years that are very familiar with this. And they found it to be a great tool. The Accelerator is, as far as I've been in deferred comp and qualified plan administration, it's the most powerful thing developed in the 28 years I've been in the business. And the goal is Accelerator. Is what we're trying to do is we're going to actually not only protect and help save taxes, but we're going to help accelerate the growth in the returns of our client's business. And typically what you're going to find is that the proposition that people have is, hey, I can protect your money, but you have to route critical cash flow and capital away from your business to do it. Or I can solve your estate planning, but you're going to have to route critical and cash flow away from your business to do it. Or I can solve your tax planning, but you're going to have to route critical cash flow and capital away from your business to do it. Our model is, no, we can do all those things, but we can also enhance your cash flow and your business capital and returns. That's an unseen proposition as far as I'm concerned. So looking at our client and our exposed to protected balance sheets, what are we going to try to accomplish here? The first step that we're going to have is, again, they're going to say, TRUST-CFO, we're hiring you. We've looked at all the cash flows, and this looks great, and we want a private retirement plan. And then what we're going to do is we're going to say, okay, you client have an active business, and the active business is generating active earnings, and that's going to come in the following forms: C Corp stock, S Corp stock, and LLC member interest. So again, you can have an LLC that owns real estate that's passive, but a lot of clients have LLCs that run active business, widget makers or sales or whatever. Okay, these are active earnings. Let me make a statement here. Again, what's the difference between a private retirement plan? You can fund S Corp stock into a private retirement plan. You cannot do it in a qualified plan. You can fund it C Corp stock in a qualified plan. It gets a little messy, and sometimes it's appropriate, but 95% of the time it's not. Our clients literally could say, well, wait a second. We ask, why are you building your business? Well, because I want to build it and make a ton of money and have a lot of revenue. You really, why? Well, because I want to sell it one day for a ton of money. Okay, and then what are you going to do with that ton of money? Well, then I'm going to live off of it. So if you break it down, why are clients building their business? It's for their private retirement. That's exactly why this was set up in 1970, because California said, hey, we know that these other retirement plans can't fortify these people that are building the private assets. So if you have a private retirement plan, you can fund private stock and real estate and private equity and those assets and make sure they're exempt. Why? Because they're for your retirement. And that's what we're talking about here. This is a step I see a lot of people stepping over, is like they just don't know or don't think that the clients can fund their stock or their member interest, even though it's active and they're an executive, and fund those into the private retirement plan and claim that exemption and protection. Which, by the way, if you're looking at the protection of the core, the asset value, the paper value that you have sitting in the safe, meaning the stock certificates of a corporation or the member interest certificates of the LLC, those things generate profit. In the form of corporations, it's dividends. In the form of LLCs, it's distributions. And so what you're doing is you're not only capturing the current value of the equity of the stock or member interest, you're collecting all the future distributions and cash flows from that. So it becomes an accumulation model. It's extremely potent. So that's a great starting point, but we're not done yet. What happens is when we capture those dividends and distributions, they're taxable. So at the end of the day, what happens is in a grantor trust, which a private retirement plan is actually called an employee grantor trust, not an employer grantor trust. And so everything flows through just as if they'd owned it, and it's funded from their balance sheet. But all the earnings that flow through are taxable just as if the client had owned it. And that's going to be perpetrated through a 1041 tax return that then flows through onto the client's 1040. Okay, and whether that's through a K1 or 1120S, et cetera, that's how that works. So you're not getting any tax bang out of this as of yet, in terms of a one-dimensional thinking of funding the stock. So that's where we come in. Well, wait a second. The assets of the corporate stock and member interests are now owned by the private retirement plan as the shareholder, and it has a goal. It is incentivized to make sure that that retirement plan reaches its objectives. And there's a lot of volatility in business, as everybody knows, and as we're experiencing with this stupid COVID-19 dilemma. Okay. And people are laying off employees, and they're, it's a bit of a calamity, and hopefully we have some rescue with that from the government. But in the meantime, this has a lot of risk. So what we do as TRUST-CFO is we're about risk management. So what we're going to do is say, well, listen, as those distributions and dividends and cash flows come in, we want to set aside some of those, and we want to memorialize and monetize a reserve, a pool of funds for a rainy day to make sure that we know that we're going to have that money for retirement. So what the PRP can do is it can set up a risk reserve pool, and this is buying a special type of casualty insurance called excess and surplus lines. This is not your Allstate. This is not your, INGs of the world. Excess and surplus lines is extremely different. You have to have your own special license, and my underwriters are on the call right now, and they specifically evaluate and look at revenue risk. Now, so this is a key distinction. When you're buying casualty risk, you're buying it, on, somebody slips and falls, I have liability, I have umbrella. Well, that's not revenue risk. Revenue risk is insurance is a total different animal. What you're doing is saying, hey, what if something happens in my business that hammers or eliminates my revenues? And these are more esoteric things and deep thinking things like loss of contract, loss of key employee, trade risk, loss of inventory. I mean, all these things, and a business has an unlimited amount of these risks. And so what we do is we inventory that and we quantify it and come up with what reasonable amount can we provide that justifies the risk reserves, and we underwrite it with my team, and we come up with a solution that is justifiable through underwriting. And so this becomes true insurance coverage. And the good thing is that, again, we can sock away those, we get it on a pre-tax level so they become deductible, but there is a challenge there. I mean, these premiums are high. So you could have $1 million, $2 million. We did one and then last year, $3 million plus. And at the end of the day, that's great, because what it's doing is it's making these reserves that would otherwise be, or these cash flows that would otherwise be taxable, now pre-tax. The problem is, just like anything else, and I don't care whether that's funding a qualified plan or buying equipment, is once you take those dollars and you fund a casualty revenue risk policy, those dollars are not usable now in the business. So it can be a cash flow crunch. Meaning, if you say, well, I'm going to fund $1 over here and I'm going to get a deduction on that dollar, that's great, you save 50 cents, but I spent $1 to do it. So I'm down cash flow. So we've created a methodology through my banking experience by which to alleviate that cash flow pressure. So what I'm going to do is, again, recap here. We're buying revenue risk insurance, creating reserves, a reserve pool. It's true insurance coverage. Okay, and this is supported by, it's an A-rated carrier on the London Exchange that's backing us up. It insures against active, passive, and capital gains taxation, but through our financing, our clients will only have to come up with 10% down funding to be able to do this. And this is what everybody does at a fortune level, is they don't write checks for insurance. That's a cash flow killer. What they do is they say, we're going to buy insurance, we're going to deduct it, but we're going to finance it over term, so that we basically have our business, our money working in our cash flow. And they create the arbitrage against their business growth versus the cost of monies. So again, what we're doing is we're going to create a TRUST-CFO financing arrangement where we say we will carry the cost and finance the premiums for this over a period of 5 years, and we can renew, so it can be 5, 10, 15, or 20 years. And we're going to do this at interest-only rates. Okay, and we don't charge year one, so it's year 2 through 5, somewhere at a 2.5 to 3.9% interest rate right now. And by the way, don't forget, these casualty risks are deductible, so you got to look at your net cost is somewhere between 1.25% and maybe 2% carrying cost for our clients. The key that I've come up with is, typically when you start borrowing money or financing things, there's additional collateral required. And that starts to intrude on the business lines in that active business. And so what we are able to do is we're able to get the financing arrangements so it's self-collateralized only against the risk reserve insurance, and it does not disrupt or inhibit or intrude, is a better word, on the existing lines and the banking lines that right now the businesses are all going to. So we don't want to suck up that opportunity and dilute their ability to capitalize on debt and grow their business. And so this becomes a self-sustaining model where we can take profits, create deductions, finance it without disruption. Again, I've been doing this a while, even did this in deferred comp, and this is a much better model, a non-intrusive model. So again, you can see again, there's a couple different components that are working together. They're powerful in their own right. And then again, what are we trying to do is we're trying to provide the client with certain things that they're looking for that they can't get otherwise, which is tax deferred capital, which then provides increased cash flows. Then that translates to increased net returns, and it's all risk managed from head to toe. We have it not only creditor protected, okay, at each step, but we have all the risk management lined up so that we don't have volatility in interest rates and things like that. So again, it's a fully risk managed model. Let me show you what this looks like in terms of numbers.